Welcome to the Encrypted Oracle. Imagine losing 80% of your wealth in under 12 months. I'm not talking about a college student gambling his savings. I'm talking about Tiger Global, one of the most respected hedge funds in the world, which lost over $17 billion in 2022. I'm talking about Three Arrows Capital, run by two Columbia graduates with decades of experience in the most sophisticated markets on the planet. What went wrong? It wasn't bad luck. It wasn't an unforeseeable black swan. It was a specific, repeatable, and devastating mistake, one that has a name, a face, and that the vast majority of investors, including you, are making right now without even realizing it. Today on the Ciphered Oracle, we're going to decode it together. Here's a number that should stop you cold. According to S&P Global's SPIVA report, 93% of actively managed funds in the United States failed to beat the market over a 20-year period. 93%. These aren't amateurs. These are the world's top analysts, with access to privileged information, cutting-edge mathematical models, and entire teams dedicated to finding an edge. And they still fail. Why? Because the sheer volume of information they handle doesn't protect them from the mistake. In fact, and this is what we're going to prove today, more information can actually make you a worse investor. Bitcoin has been the most brutal and transparent laboratory for observing this phenomenon. No asset in history has so systematically humiliated the so-called experts. And the reason is always the same. The mistake isn't in the markets. It's between your ears. It's called confirmation bias, the automatic tendency of the human brain to seek out, interpret, and remember only the information that confirms what we already believe. It was formally identified in the 1960s by psychologist Peter Wason, but its impact on finance wasn't truly documented until Daniel Kahneman, Nobel Prize winner in economics, proved that even the most highly trained professionals fall victim to this mechanism. Think of it this way: if you already believe Bitcoin is going up, you'll unconsciously read only the articles that confirm it, remember only the predictions that got it right, and ignore, literally automatically ignore, any warning sign that contradicts your narrative. Your brain isn't searching for the truth. It's searching for the reason you were already right. Let's talk about a concrete case, because abstract numbers don't hurt. Three Arrows Capital, known as 3AC, was at one point the most powerful crypto fund in the world. Its founders, Su Zhu and Kyle Davies, were considered oracles, ironically, of the cryptocurrency market. They managed over $10 billion. They had access to all the market data, contacts at every exchange, and supposedly sophisticated risk models. Their mistake? They were so convinced that crypto could only go up that they systematically ignored every signal of the Federal Reserve's liquidity tightening in 2022. They had the information. They discarded it because it didn't fit their narrative. The result: total bankruptcy, debts exceeding $3.5 billion, and their founders literally disappearing on a sailboat. Confirmation bias does not Stop. Pause for a second. I want you to do this mental exercise right now as you're listening. Think about your last major investment decision. Now answer with brutal honesty: did you actively seek out arguments against your position before investing? Or did you only look for confirmation of what you already wanted to do? If the answer is the second one, you've just identified the exact mechanism that destroyed Three Arrows Capital, Tiger Global, and thousands of individual investors in every single crypto bear market. This is the moment in the video where 80% of people feel a slight tightness in their chest because they recognize themselves in that description. And that discomfort matters. It's the first sign that you can change. The people who turn off the video now are the ones who will repeat the same cycle in the next bull market. The ones who stay are the ones who will learn to protect themselves. Bitcoin is unique as an asset precisely because it functions like a psychological lie detector. No other market in history has generated such extreme cycles of euphoria and panic in such short periods. From $69,000 in November 2021 to $15,500 in November 2022. A 77% drop in 12 months. What were the most bullish analysts saying at the peak? That Bitcoin would reach $500,000 before year's end. Plan B and his stock-to-flow model was cited across every major media outlet as the definitive model. The problem wasn't that the model was necessarily bad. The problem was that nobody, absolutely nobody with a bullish narrative, was looking for reasons it could fail. Confirmation bias had captured an entire industry simultaneously. And when Bitcoin crashed, it didn't just ruin individual investors. It ruined funds, companies, and entire platforms like Celsius. And since we're talking about FTX, let's use it as the most painful and most instructive case study of the last decade in crypto. Sam Bankman-Fried, a curly-haired young man in a t-shirt and shorts, built an empire valued at $32 billion. He was on the cover of Forbes, Fortune, and Time. He dined with presidents. He donated millions to political campaigns. He was the prodigy who was going to bring crypto to the mainstream. And you know what the world's most sophisticated institutional investors did? Sequoia Capital invested. The Ontario Teachers' Pension Plan invested. SoftBank invested. Why? Because the narrative fit perfectly with what they wanted to believe. A brilliant altruist, effective altruism, friendly regulation, exponential growth. Nobody wanted to look for the red flags. A balance sheet that circulated months earlier showed enormous irregularities. But confirmation bias had blinded even the most rigorous due diligence teams in the world. Result, total fraud, $8 billion of customer funds gone, and Sam behind. Alright. Now the part that holds the most value for you today. Here are the 5 signs that you are committing the confirmation bias mistake in your investments right now. Number 1, you only follow people on social media who share your same opinion on Bitcoin or crypto. Number 2, when someone criticizes your favorite investment, your first reaction is to attack the person, not analyze the argument. Number 3, you clearly remember every correct prediction your favorite analyst made, but you don't remember their failures. Number 4, you have never written down on paper the arguments against your position before investing. And number 5, the most dangerous of all, you feel you understand the asset so well that additional analysis is no longer necessary. That feeling of absolute certainty is exactly the trap. Markets punish certainty. They reward intellectual humility and active risk management. If you identify with 3 or more of these points, this video arrived at exactly the right moment. So what sets apart the investors who actually preserved their capital during the 2022 bear market? They weren't necessarily the smartest. They were the most disciplined in following a specific protocol. First, they practice what's called inverse thesis analysis. Before every investment, they write down on paper all the reasons they could be wrong. Second, they have predefined, non-negotiable loss limits. No matter how much they believe in the asset, if it falls a certain percentage, they execute the stop. No emotions. No exceptions. Third, they actively consume content from people who disagree with them. Not to capitulate, but to calibrate their thesis. Fourth, they separate narrative from price. Bitcoin can be revolutionary long-term and still fall 60% in the short term. Both things are simultaneously true. And fifth, they always maintain a cash position. Because the biggest opportunity of your investing life in crypto arrives when everyone else is liquidated and desperate. And to take advantage of it, you need available capital. We've reached the end of this analysis, and I want to leave you with something concrete you can apply today, not tomorrow, today. Before you make your next investment in Bitcoin or any crypto, spend 20 minutes writing down on paper or on your phone a list of every reason you could be wrong. Not the reasons you're right. You already know those. The reasons you could be wrong. If you can't generate at least 5 solid reasons, you're not ready to invest in that position. That's not negativity. That's the difference between surviving the markets and being destroyed by them. At the Ciphered Oracle, we keep decoding the patterns that the mainstream ignores so you can make smarter decisions with your money. If this analysis opened your eyes, subscribe now, hit the bell, and share this video with someone who's thinking about investing. Because the best time to learn from a mistake is before you make it. I'm Kim. Listen to this carefully, because it's the most expensive lesson any investor can learn: the market always wins. Always. It doesn't matter how many degrees you have, how many years of experience you've accumulated, or how much money you've made before. In 2022, the most sophisticated hedge funds on the planet collectively lost over $200 billion. People who studied at Harvard, MIT, Oxford. People with artificial intelligence algorithms. People with legally privileged information. They all lost. The market does not respect resumes. This video is possible thanks to Binance. Compare Bitcoin sin commissions. Link in description. Here is the weapon that destroyed Three Arrows Capital, Archegos Capital, and dozens of other funds you'll never hear about because they vanished in silence. It's called leverage. Imagine you have $100 but you borrow $900 more to invest with $1,000. If the market goes up 10%, you make $100 and double your capital. Sounds incredible, right? But if the market drops just 10%, you've lost everything. Zero. And if it drops 15%, you now owe money you don't have. This is exactly what Bill Hwang did with Archegos in 2021. He took on $100 billion in positions with only $20 billion in real capital. When the market moved against him, he lost $20 billion in 2 days. 2 days. Leverage multiplies gains, yes, but first, it multiplies your destruction. I'm going to tell you something that most investors learn too late and at too great a cost. Diversification is not a conservative strategy for fearful people. It is the only mathematically rational strategy that exists. Ray Dalio, founder of Bridgewater, the world's largest hedge fund managing $150 billion, calls his portfolio the holy grail of investing. You know what his secret is? He holds between 15 and 20 uncorrelated assets. Assets that don't move together. When crypto falls, his bonds rise. When stocks fall, his commodities rise. The point is not to eliminate risk. The point is that no single event can ever completely destroy you. 1998, Long-Term Capital Management. This fund had 2 Nobel Prize winners in economics on its team, Myron Scholes and Robert Merton, the very men who invented the mathematical formula for pricing financial options that is still used today. Their model was perfect on paper. Their computers said the probability of bankruptcy was 1 in a billion. Impossible. Except it happened. Russia defaulted on its debt, global markets panicked, and the correlations their model had assumed impossible all occurred simultaneously. The fund lost $4.6 billion in less than 4 months. The Federal Reserve had to organize an emergency bailout because if LTCM collapsed, it could have triggered a global financial crisis. Mathematical models assume the past predicts the future. The market makes it its bit. Let's talk about something nobody wants to admit but that destroys more portfolios than any market crash: ego. The investor's ego has one specific and deadly characteristic. It refuses to admit it's wrong. You know why the best traders in the world have limited losses? Because they have automatic cutoff rules. If a position falls 8%, they exit. No debate. No waiting for a recovery. No telling anyone about it. They just exit. The average investor does exactly the opposite. When a position falls 8%, they can't exit because that would mean admitting they were wrong. So they wait. It falls 15%. They keep waiting. It falls 30%. By this point, the position has become so psychologically significant that selling would feel devastating. And so what could have been a small loss becomes a life-changing loss. The market doesn't know you bought. The market isn't against you. The market simply exists. There is a new form of confirmation bias that is destroying the youngest and fastest moving generation of investors in history. It's called the financial echo chamber of social media. Here's how it works. You follow a crypto influencer who says Bitcoin will reach $500,000. You get excited and invest. The algorithm on Instagram, TikTok, and Twitter shows you more people saying the same thing. Every day you see more confirmation that you made the right decision. Your brain releases dopamine. You feel validated. Like a genius. Meanwhile, the analysis that contradicts your thesis exists, but the algorithm doesn't show it to you because you don't engage with it. In the first quarter of 2022, over 2 million people across Latin America lost significant savings and assets they had discovered exclusively through social media. The social platform has no incentive for you to make money. Only for you to keep staring at screens. Warren Buffett has been investing for over 60 years. He lived through the crash of 1987, the dot-com bubble of 2000, the financial crisis of 2008, and COVID in 2020. Not one of those events destroyed him. Why? He has 3 rules. Just 3. First, never lose money. Second, never forget the first rule. And third, only buy what you can explain to a 10-year-old. That's it. No quantum just discipline, patience, and something very few investors possess, the ability to do nothing when there is nothing intelligent to do. In 2020, when everyone was panicking and selling, Buffett had $137 billion in cash just waiting for the right moment. Patience is not passive. It is the most active and after everything we've seen today, Three Arrows, LTCM, FTX, Archegos, we arrive at the most important moment of this video. Your personal financial survival plan. These are 5 concrete steps you can implement this week. 1. Never invest more than 5% of your capital in a single speculative asset. Never. 2. Define your exit point before you enter. If it falls 15%, you exit automatically. No debate. 3. If you're going to use leverage, use a maximum of 1/10 of the money you'd normally use. Or better yet, don't use leverage at all until you've been consistently profitable for 2 years. 4. Actively seek out information that contradicts your investment thesis. If you can't find a solid argument against it, you haven't researched enough. 5. Separate the money you'll need in the next 3 years from your investment money. Money you need cannot be at risk. I want to leave you with a mental image that will change how you think about money forever. Picture 2 investors. The first gains 50% in one incredible year. The second gains just 12% every single year without exception. At the end of 10 years, who has more money? The second investor. Every time. Because after that incredible year, the first investor inevitably faces a terrible year where they lose 40% trying to repeat the success. Consistent mediocrity beats inconsistent genius every time. Market data from the last 100 years shows that the average investor who simply bought an S&P 500 index fund and never touched it outperformed 93% of active professional managers. Not because they were smarter, but because they didn't make the mistake of believing they were smarter than the market. Financial humility is not weakness. It is the strategy of those who actually win. We've reached the end, and this is the most important thing you'll hear today. Knowledge without action is worth absolutely nothing. Right now, in this moment, you have 3 options. The first, ignore everything you've learned, keep doing what you've been doing, and hope that somehow it'll work out differently for you than it did for Three Arrows Capital, for LTCM, for the millions who lost everything. The second, save this video, tell yourself you'll apply it someday, and that someday never comes. The third, do one thing. Just one. Tonight, open your investment portfolio, whatever size it is, and honestly evaluate how much is concentrated in a single asset. If it's more than 30%, you have homework. Subscribe to this channel, because in the next video I'm going to show you exactly how to build a portfolio that can survive any market storm. Share this video with someone who needs to see it before they make the most expensive mistake of their life. Subscribe to the channel and ring the bell to never miss a video. Every week we publish information that can change your financial future.